a young workforce, policy support through the government's Make in India campaign, and the China Plus One strategy of creating alternative manufacturing destination. Together, it's a potent trinity that is pushing India to claim its place as a global manufacturing hub. Already, as per Cushman and Wakefield's 2021 Global Manufacturing Risk Index, India has emerged as the world's second most attractive manufacturing destination. India's own vision is to scale up the contribution from manufacturing to 25% of GDP from the current 15%, a potential $500 billion opportunity annually. This projected growth in manufacturing also presents an investment opportunity. And here, let me introduce you to our own Trinity, a three-fanged approach which can help you ride the manufacturing growth story. Infrastructure, BFSI, and the global and multinational companies with a focus on exports. After all, the manufacturing opportunity will provide a fillip to its entire ecosystem, so as to say that a rising tide lifts all boats. Which is why the Power of Trinity is a solution crafted by SBI Mutual Fund to bring together the most opportunistic themes from this entire ecosystem in the form of three funds, each of which are closely entwined with this manufacturing push. So let's start with infrastructure. Over the last 10 years, we have seen an underinvestment in capex. This lost decade for India's infrastructure sector looks to be reversing now, and here are 5 reasons that stand out. Improvement in corporate profitability. Improvement in capacity utilization. Factories are no longer idle. Reforms led boost to manufacturing like the production-linked incentives or PLI schemes. Higher infrastructure budgeting. Funding capability comfort, or simply more loans being given by banks.
We continue to be positive on the capex cycle, and we have positioned our fund accordingly with an overweight on capex beneficiaries. However, looking through the past cycle, where we saw significant drawdowns with a higher concentration of one particular sector such as capital goods and construction, we have spread our risk across multiple sectors such as capital goods, cement, oil and gas, power, etc. Now, within the capital goods, where we are seeing exuberance on the valuations, we have positioned our fund with a higher weight on consumables, which are more defensive nature, valuations are reasonable, and they are beneficiaries of newer sectors. Within power, we have positioned our fund to beneficiaries of power distribution reforms.
Up next is BFSI. BFSI means banking, financial services, and insurance. The revival of the capex cycle naturally means more work for banks and financial firms. Every project needs to be funded, right? So here are the 5 most compelling reasons why the BFSI theme holds potential. Credit pickup. Remember the increase in loans we spoke about? Well, it's a positive for financial companies also. It's a cycle after all. Improving asset quality. Bank balance sheets are in better shape today. 3. Large private banks are gaining market share. The big private banks are well positioned with management stability, strong liability franchise, and they also have strong retail deposits and diversified loan books. Tightening liquidity. The fight for deposits has intensified, and our investment team's preference is for entities that have strong liabilities franchise. 5. Non-banking financial companies or NBFCs targeting niche segments like micro, vehicle, gold, and housing finance are all expected to see strong growth.
We are positive on the banking and financial services space because we believe the valuations are quite compelling versus the earnings growth that we expect over the medium to long term. In terms of the portfolio construction, while the fund is constructed as a pure bottom-up stock selection focused fund, we do try and maintain a balanced mix of various subsectors, which is banks, capital markets, insurance, as well as NBFCs versus the benchmark, which is a little more heavy on the banks.
And the final piece of the puzzle is global, a mix of Indian exporters and foreign manufacturing companies enjoying strong economic moats. And here's why this global story deserves a place in your portfolio. Rising FDI flows. India's FDI inflows have increased 20 times from 2000-2001 to 2021-22. Investment destination. India is already an emerging manufacturing hub in global value chains. Resilient India. A combination of high foreign exchange reserves, sustained foreign direct investment, and rising export earnings have provided a strong footing. International exposure. The investment team has also been able to identify investment opportunities with attractive valuations. And global footprint. India also has a 20% share in the global supply volume and contributes to about 60% of global vaccines, along with being one of the largest agricultural product exporters.
So Global is a thematic fund that runs three buckets. One is stocks listed outside India. Presently, we own Google, we own Microsoft. Two is MNCs or stocks which have a foreign ownership, the likes of a Grindwell, Abbott, or a Lever. And three are businesses which derive a very significant portion of their revenues from outside India, like TVs or an Infosys, for example. I think this fund fits well along with financials and infra. So there is reasonable diversification. There is little overlap between these two funds. So it's a nice way to play a combination of these three funds. And I also think it gives you a style diversification, because this fund, because of the nature of the way these buckets are, it tends to have a quality bias, and unlike financials or infra.
Three funds, one clear objective: to be part of India's journey as a global manufacturing giant. And here's how you can invest in this trinity. On our website homepage, navigate to the Browse and Invest tab and click on SBI MF Multi-Select option. Here you will find the Trinity option especially curated for you. Make your choices, SIP or lump sum and so on, and add the amount you wish to invest in the three caption schemes. This amount may be equal for all three schemes or even differ depending on what you are most bullish on. After that, the only thing left is to sit back and enjoy the ride. Do contact your advisor or distributor for more information on these schemes. If you like this video and want to watch more such content, do remember to subscribe to our YouTube channel. Thanks for watching and happy investing.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.